U.S. crude stocks and fuel inventories all down by more than expected in the latest week as demand and exports rose. Let's get more on the global picture for oil. We're joined by Livia Gallarati, senior oil market analyst at Energy Aspects. Thanks very much indeed for coming on the show.
Thank you for having me.
So it looks as though the U.S. market for petroleum products tightening, but we had a commentator on just a little bit saying that a while ago, saying that, you know, it looks like the market is less interested in inventories and supply and demand and is just worried about the macroeconomic weakness that many investors fear.
Yeah, absolutely. And look, I think one thing that we have to keep in mind is at the moment we are in one of the periods of the year that typically sees the lowest participation and liquidity in oil markets generally. It's the middle of August, and other than Christmas week, that's when most people are on holiday. So things like macro data and generally financial selling is even a bigger driver at the moment than it typically would be. So other than fundamentals, of course.
That's interesting because a lot of European countries in August just shut down, don't they? They're very civilized. And I guess people are on holidays in North America too. So can that contribute to price swings in oil, the lower volumes?
Yeah, absolutely. And this is exactly what we've seen over the last couple of days. We've seen crude prices come off significantly. And the biggest driver has been CTA selling in reaction to some of the macro data, which has been bearish, but it's definitely not been as bad as maybe some in the market had expected. And fundamentals are still very constructive. You have cited the US inventory data that came out earlier today, and that was a lot more constructive than most of the market was expecting.
Talk to us about Libya. Obviously, that country has been a tragedy. Is putting it mildly over the past decade. What's happened there? But they have a crucial oil field that's been shut down. What are the prospects for it reopening, and would that affect the global supply of oil significantly?
So the production outages that we're seeing occurring at the moment in Libya are definitely adding to the overall tightness in the Atlantic Basin crude market, particularly for light crude, because remember, we have a lot of different qualities of crude oil, and at the moment, what's physically the tighter type of crude is light crude, and that's exactly what is being produced out of Libya. There is a key field that has been shut down since the start of this month, and it doesn't look like that's coming back online anytime soon. We at the moment expect it back maybe by September, but even that's not guaranteed. And we're talking about around 200,000-300,000 of production in terms of barrels per day. So it's quite significant.
A big overhang for the market has been concerned about the Chinese economy. But you think demand in China is now about as weak as it's going to get?
We've had some pretty weak data releases in terms of oil demand and refinery runs coming out of China over the last few days. And here we're talking about July data. So obviously, as everything with oil markets, it always tends to be quite backward looking when it comes to available data. But yeah, I mean, we definitely think that the worst is behind us in terms of Chinese oil demand. Some of the weakness that we've seen recently has been driven by weak construction and industrial demand. We think that's going to improve. There is also coming up a few key holidays and festivals in China, which typically drive stronger demand for the transportation fuels. So that should help as well.
Broadly speaking, then, what is your call for oil over the next year? Do you think prices will generally move up, the global price of oil?
We think they will. I don't think we are going to get back to, maybe at the beginning of the year, some were thinking prices could go well above $90 and even more than that. I think these levels are harder to achieve this year for the simple fact that we have things like the OPEC production cuts that will be quite responsive to the markets to bring back barrels, if prices were to rally significantly. And on the other side, we have also things like the SPR releases in the US that can come into play if prices surge above $90. So there is upside from current levels because the physical market is so tight. And as we get out of the current low liquidity weeks, we should see that, into action. But probably not, not huge upside